have invited Chris Matthey from the Mortgage Professionals to give us an update on mortgages and what's happening with interest rates. Welcome, Chris.
Yes, thank you, Diane. Glad to be here.
And before we begin, I just wanted to give you a snapshot of what's going on in real estate. Well, I don't want to bore you with all the statistics, but just know that Kingston's average price at this moment is about $736,000. Crazy stupid. And hopefully this will start settling down by the summertime. As with inflation going up, gas prices going up, the war in Ukraine, and we've got possibly some more interest rate increases. This should settle the market down. We have seen indications lately, and we will see what happens over the next couple of weeks.
Just another point there is that March is our busiest time traditionally, and we'll see after March, April, as we get into April, what is happening. Volume is continually, we're about 20% down on volume over last year at the same period. So, record lows for inventory, and that you can see is still driving the prices up in our area. So, all right. So Chris, tell us what's going on in the interest rates, and how would you like to segue into this?
Yeah, well, that is there's lots going on with interest rates, and you look all over the media and they keep talking about rates going up, and right behind that, they're talking about inflation. And kind of the Coles notes on that is there's really no slowdown or end in sight, at least in the short term in that regard. One important distinction I want to note, however, is that when we're talking about, the Bank of Canada is talking that they're going to increase their rates 2% over the next 2 to 3 years, and rates are going up, inflation creating rates going up. A lot of that is speaking to prime rate, and that has to do with variable. Okay, and those projections are on variable. Now, interestingly enough, we are seeing fixed going up as well, okay? But just because they're talking about 2 to 3% over the next 2 to 3 years, the important thing to note is that they are not necessarily talking about fixed going up 2 to 3%. And the biggest reason for that is because what drives each of them is very different. Variable rate is determined by the Bank of Canada, and the Bank of Canada sets its rate policy in order to cause an effect in the economy. And right now, the duty of the Bank of Canada is to fight inflation, right? Prices are going up, not just in housing, but we see gas prices going up, we see goods going up, etc. So the reason why they want to increase prime rate is because they want to slow down borrowing, they want to slow down spending. So hopefully they can cause a slowdown in this increase in prices. Okay, so that's what they're looking to do on that side of things. Very proactive. On the fixed side, the fixed rates, that's really a byproduct of what's going on with the stock market and bond market. It's a dynamic between the stock market and bond market. Fixed rates largely are determined by the bond market. I mean, there's a couple other variables that go into it, but essentially what happens is you've got bond rate, then you've got a profit margin, and that's how you set your fixed rates, or how rather lenders set fixed rates, because a lot of lenders are actually lending off of bond money. So what happens, how those rates go up and down, is it depends on the market activity. So you have all of these investors that want to put their money into the market. And when stocks are good, they're putting their money into the stock market, right? So when we see TSX is doing well, et cetera, that's where investors are going. So the bond people are sitting there saying, geez, we need an influx of money. We need to make our bond attractive. So if we're losing all of these investors from bond and going into stock market, we've got to increase the bond rate to attract some of these people back. And so that's when we see fixed rates go up. So traditionally, when we see stock markets doing well, that's when we see higher fixed rates. When we see the opposite happen, where we start to see some uncertainty, that's where we typically start to see a drop in interest rates. So that's kind of what's been going on right now. To put it in perspective, about this time last year, January, February last year, refinance rates were around 1.99%. Purchase rates were around 1.69 to 1.79-ish. And today we're sitting here and the purchase rates are 2.99 on average, and the refinance rates are 3.24 to 3.29. And that's just over 12 months. What will it look like in the next 12 months? We don't know, again, because it's on the fixed side of things. It just depends what goes on in the markets, right? And, that's largely depending on what's happening in the world around us, right?
So the last interest rate is what you're saying, is that it would not, the interest rate increase that they just announced, 0.5%, wasn't it? 50 basis points?
It was a quarter point. Yeah.
Oh, a quarter. Okay.
Point interest. The overnight rate went to 0.5%. So it was a quarter. It went from 0.25 to 0.5. So it was a quarter point increase. So those in variable rate right now, prime rate, which is what variable rate is based off of. If you look at your mortgage statement, it'll say prime less something. Prime rate was 2.45. It's now gone up by and large to 2.7.
Okay. So that wouldn't affect somebody going into, like you said, into that fixed interest rate. So other than the bond going up and down. So interesting. Okay, that's good to know. So with that, a lot of what I have a lot of clients asking me is, okay, where can I get the cheapest rates for? Do you know anybody that would offer me a really good rate on mortgages? And I kind of understand from your perspective that it's not only about that interest rate. Can you go into those that are shopping around for interest rates, what they need to be aware of?
Yeah. The first bit of advice I would give to them is really understand what's the most appropriate fit for you. And by fit, I mean, there's so many options, right? Does it make sense to go variable? Does it make sense to go fixed? And right off the hop, kind of the difference between the two is variable will be the lowest rate, right? It's been shown time and time again that the person who goes variable for the life of their mortgage, they will do better from an interest paid perspective than the person who went 5-year fixed every 5 years for the life of their mortgage. However, there's risks involved because right now we're in an environment where rates are going up. The variable rate is going up. So, so too will your interest rate on your mortgage if you are variable. Fixed, what will happen is you have a locked in rate for the next 5 years, but you're paying a premium to do it, right? So somebody today who has a variable prime -1, let's say, is kind of an average purchase interest rate. So that would be 1.7 today. Well, the corresponding fixed is 2.99. That's quite a considerable spread. I'm also seeing, these teaser rates of, prime -1.25, prime -1.46, and they all have different criteria in it. There's a lot of fine print to be aware of. And I'll talk to that in a moment. So in terms of fit, what is your situation? Do you have very little disposable income? Perhaps you're a young family, you're going to have daycare costs. You've got, maybe you're putting the children in different sports, et cetera, et cetera. And from a budget perspective, there's very little disposable income. So in that perspective, that's a terrible fit for variable because the risk is if rates go up, that's going to impact your budget, right? So in that scenario, that's a better fit for fixed. On the other hand, if somebody has a little bit more disposable income and they can handle the risk of the interest rates going up and or down, that's a terrific fit for variable because they can do a lot while they're in the mortgage to reduce the amount of interest that they are paying. So fit is probably the first bit of advice I would give them. And then the second bit of advice is really understand the fine print that comes along with the mortgage. What are the prepayment privileges? What is the penalty clause? And that's a specific. So in regards to prepayment privilege, a lot of first-time home buyers, let's be honest, they don't have a lot of extra money to put down against their mortgage over the first 5 years. So perhaps prepayment privilege isn't as big of a deal for them. If they have a little bit of prepayment, that's fine. But the bigger one is the penalty. And that's where I'm seeing a lot of clients get stung because the standard penalty is going to be much lower than some of these teaser rates or no frills rates, et cetera. And it could be the difference of paying $4,000 on a penalty to break your mortgage than paying $15,000, $16,000, $17,000 on your mortgage paying a penalty. And statistically, the numbers are against you. Right? It's statistically, last I knew, I think CMHC was saying that first-time buyer moves within the first 3 years of having their mortgage. Now, because of what we talked about earlier, being the market that it is, the housing market, maybe people will stay longer. But understanding that the fine print could mean the difference of tens of thousands of dollars in savings in your mortgage over the X number of years. So really understand the fine print. And that's where whoever you're working with, whether it's with the bank or a broker like myself, really make sure they understand the product that they are selling you and make sure that you understand the product that you are receiving. Very good idea to go over that in detail.
Yeah, and I have been through a time where, when I first got into the industry, that, people were not understanding that penalty as they get out of their mortgages, because they're going to sell their house. They're going to, take time, look for the next house, the perfect house. And they don't realize that, did they have a porting clause in their mortgage? And can they get out without penalty? And there were some buyers or sellers that had $15,000 penalties that they had to pay. So, it may not seem a lot today, but that escape clause, if you want to call it, because right now you can sell your house very quickly, but buying, it could be a year down the road before you find the next house, and you might be moving in with mom and dad until you can find that house that you can really afford, and wait for that market to go down. So understanding what it is that's going to get you out of the mortgage is crucial. You've just, you may save a little bit up front on your interest rate, but it's what is at the end is the kicker. Yeah,
that's a great point. And especially when you think about the fact that now it's getting harder and harder to qualify for that mortgage, whether it's your first mortgage, second mortgage, doesn't matter, because the requirements to get in have become a little bit more substantial, right? Even though we're talking about rates being, low 3%, we're qualifying at 5%, right? On top of that, the price of the home that you're trying to buy for is that much more. And let's be honest, during the time that we've seen housing prices explode, we were talking earlier about how income has been static, right? Somebody who was earning $70,000 2 years ago, and we're looking at houses at $500,000 2 years ago, are now looking at houses $700,000, and their income might be $71,000, $72,000, $73,000. So income is not really helping this scenario while housing prices are going up and up and up.
Yeah, that is key. What are you seeing as far as the type of people that are getting into the market? What appears to be the that baseline of what they're cash they're coming in with, and where are they getting their down payments, and what is the profile of the average buyer you're seeing right now?
Yeah, now we're seeing kind of intergenerational buying, where we're having mom and dad step in either with a substantial gift for down payment, and or they're stepping in and qualifying and being on that mortgage and being on title for their son, daughter, whatever the case may be. And that is something that unfortunately I don't think is going to go away, because again, income being static, somebody who's let's say young professionals have just entered into the work world and they're making $50,000 each and they have a reasonable amount of debt, they're not unfortunately going to qualify for much. So they need that assistance either through down payment and or co-signing from their parents. So that is something that I'm seeing lots more of. And then, unfortunately, I'm also seeing people who are just leaving the market altogether just because they, can't find anything because the amount of competition that is out there, because they just can't get a successful offer. And then two, with pricing going up and up, the longer it takes them to find something, the less chance they have of remaining in a situation where they're going to qualify, right? People who were looking last year that just barely qualified last year are in a position where they're not likely qualifying this year because that price of home has gone up that much more.
Yeah, I'm constantly, reiterating to my clients that, I would like the time to be picky about a house is kind of gone. You need to be in almost, not panic mode. I don't want people to panic, but just to understand that every day that goes by or every month that goes by, your purchasing power is being reduced because house prices are going up, interest rates are going up, and the amount that you are going to be able to qualify is just continually getting whittled away. So, we can't focus on, yes, it needs to be repainted and stuff. We need to, you're going to have to, there's going to be some elbow grease in this house. But you got to make sure that it first functions for you. Don't be irrational and buying the first thing that comes along, but you really need to take every house that we look at seriously. You have to have, if you really want to be in the market. And then I also caution people, like, do you really have to buy right now as well? Because those are just on a whim to, we got to get a house because it's, next year there may not be any houses. That's not realistic. It's a dynamic that's hard for sure, making sure people are doing rational decisions.
No, absolutely.
I guess another question is there, a lot of folks are looking for that ideal mortgage, and they typically hear about the traditional products out there, but what other products can you offer them? Like you have B lenders and stuff like that. Is it a downgrade for a person to go into a B lender? Like it seems like a step down, and maybe it's stigmatism around B lenders, but is that a tradition, or is that a fad that's going on, or something?
Yeah, it's actually a great point. Sometimes it's a matter of keeping in that house and correcting something that needs correction, and it's very short-term B lending. So I wouldn't say it's a step down. It's really just a means to an end for a lot of people, in terms of maybe somebody has had some credit issues because of COVID. They were laid off for a couple of years. Now they've just returned to work, but they've taken on so much more debt. So they're having to clear out that debt, and maybe because they haven't been able to make payments as regularly as they wished. Or even here's one that most people don't know, is that the closer your balances are to your limits, the worse your score is going to be. So I've had plenty of clients whose credit has suffered greatly, not because they didn't make payments on time, but it's because they were right at the limits on all of their trade lines. So now all of a sudden they don't qualify under traditional guidelines. Now, alternative lenders by and large are really there for, it's I shouldn't say a refinance scenario, but you're kind of gateway into alternative lending is 20% down, essentially, because what they're doing is they're taking on more risk with the client themselves, whether it be because of employment, qualifying ratios, credit, whatever the case may be. But how they offset that is the security of the home. So they're wanting that down payment there to offset them. So if you're a buyer who has 20% down, okay, and you may not qualify under traditional means, an alternative lender is a great option. So rather than getting a 5-year rate at 2.99, you might get a 3-year rate at 349, or a 1-year rate at 329, for example. Okay. And now, of course, it's all scaled, right? The more of an exception a lender has to make, the higher that rate is going to be, right? You can get on up to, if your credit is, you've just come out of bankruptcy or consumer proposal or something like that. I mean, you could get up to 5, 6, 7, 8%, depending on the scenario. Okay. But I've had a lot of clients who, again, we're talking about traditionally 1 and 2 year rates, who have corrected their situation in that 1 year time. We've gotten them to the point where their credit score went from the 500s and now they're up into the 700s, and we're bringing them back to the A side, right? And what we were able to do is we were able to manage their cash flow, create a lot of savings for them so that they had some money in the bank in the event that life happens. They were able to manage their budget appropriately. They took that 2-year rate of 3.79 or whatever it was, and now we're moving them back into the A side, back at 299 after that 1 year or 2 year period of correction. So yes, I'm definitely seeing more volume with alternative lenders, and but a lot of that right now is just refinance based. It's people who have the equity in their home, but they've taken on so much debt that they couldn't have managed. So the B lending option has been excellent for them.
Yeah, what I think is perfect about what the services you guys offer as well is, that's that one-on-one conversation of that whole holistic approach to how do I, get to a better position over a certain goal period. And it might not be 1 year down the road where you can move yourself up, but, maybe it's 3 years down the road. But sitting down with someone like yourself and looking at that whole scenario is key. Like right now, we need a little bit of hand-holding, and shopping online. I guess you can speak to this better as far as what that advantage is for your clients.
Yeah. So there's those options out there. It's just understanding kind of what's important to you. If looking at getting, somebody to partner with and going through the understanding truly your situation and understanding all of the options out there, and somebody who you can pick up the phone and call or email with any questions at any time. That's sort of the partnership we take. Of course, there are online resources out there, and there's places you can kind of book a rate. But just understand, you become the professional, right? You have to be very well versed. And leading to my point earlier, you really got to understand the product that you are getting. Because now I am finding that there is more and more fine print that are tripping up clients as it relates to whether it be prepayment privilege or the penalty or even the way the mortgage is registered. These are all really good things to be aware of. And what happens if you miss a payment or two payments with a traditional lender versus an online lender? These are all things you really have to be aware of, because rate, sure, 10 basis points. So the difference between, let's say, 299 and 309 on a $250,000 mortgage might save you just about $1,000 over 5 years. That's nothing to sneeze at. It's still just about $1,000. But again, if you've gotten yourself into something that is going to cost you a $14,000 penalty instead of a $4,000 penalty, you've really lost that gamble, right? So it's just being really aware of what's out there and partnering with somebody, in my opinion, partnering with somebody who knows and to kind of protect your interests.
And I guess with the competitiveness of purchases today, with the number of buyers, we see a lot of people going in without the financing clauses, and even home inspection, which is even scarier in my book. What is your approach and recommendation? Like how should people tee themselves up for being successful in an offer?
Yeah, it's a great point. So I understand the situation that we're in right now in speaking with, realtors and, our conversations previously. A lot of situations when somebody is putting a condition in, it's limiting or really putting a cap on their chances of being a successful offer, just because there's so much competition out there. Now, since I entered this industry in 2005, my advice has been the same, in that I always recommend having, just like yourself, you've always recommended having a financing condition. We've always recommended having an inspection clause. Now, of course, my advice hasn't changed. I still recommend that clients do these things, but I also understand that the moment they put one of those in there, the likelihood is they're not going to have their offer accepted. So then my job kind of shifts to being, okay, this is what my advice is. Understand that if you're going to waive these to increase the likelihood that you're the successful offer, let's talk about all the risks involved from a financing perspective. Okay, what's the risk of me not having a financing clause? What are the things that could happen? And what's the likelihood that it would happen? And that's a fairly lengthy discussion. There's a number of things that could go wrong. There's a number of things that are unforeseeable, especially with not having an inspection. But it's really, again, another situation of understanding the scenario, or in this case, understanding the risks and understanding how you can minimize those risks or mitigate those risks. Are there things you can do to reduce the likelihood that these risks come to fruition, that they become? So that's something that I talk about with all of my clients, because it's just the reality that has become our norm now, unfortunately. So with every client I'm dealing with, it's talking about their situation and their risk for each, not putting that inspection clause in, not putting that financing condition in.
Is there scenarios where not having the home inspection has hindered them getting the approval for a mortgage?
I wouldn't say from a, did a client have a home inspection? Yes or no? Well, that's a question that lenders don't ask. Right? That's up to the client if they want a home inspection. So that's not going to break a deal just because a client did not have a home inspection. But if there's something that the lender has found out about or tweaked their interest and they're going to dig into it, sometimes the home inspection provides the answers they're looking for. And if there is not a home inspection, we can't get that answer, and therefore the deal will not close. So for example, one of the things we cannot control is the verbiage found in an appraisal. Okay, an appraiser's role essentially is to assess the value of the home, the remaining economic life of the home, comparable sales in the area, etc. And they write a report as to their educated guess, or rather their estimate as to what that house's value is based on all of those and a lot more criteria. but sometimes there's verbiage in there that we just couldn't see coming. And, we've seen things like suspected water damage in the basement, or high level of moisture suspected in the basement, or cracks seen in the foundation of the home, possible water damage, question mark. It's all kind of the same example here, but you get the point in that all of a sudden that's going to raise a major red flag for the lender if they're seeing that, oh, there could be some kind of significant issue with this property. Is this prone to flooding, et cetera, et cetera? And the only way to mitigate it really is to provide the lender more information about the property through a home inspection. And if there is none, what can we do in that scenario, right? And so that's something that could really hinder the client if something does come about or the lender does discover something. Another example would be if all of a sudden through the buying process, somehow the lender, it's discovered that there's vermiculite or asbestos in the home. Now, without a home inspection, we don't know what's behind the walls. We don't know the building material. A home inspection would reveal it. But if the lawyer is aware of the property, they have a responsibility to advise the lender of any issues, as do I. So if there's no home inspection to prove otherwise, or there's nothing to prove that all the vermiculite and asbestos that may have been there years ago is no longer there, again, this is going to be a problem for our clients, and we're going to have to work through it, whether or not they can get financing. I mean, if there's vermiculite and asbestos in a home, a lender will not move forward until they can have that vermiculite and asbestos removed.
Yeah, and I know for a fact that you guys ask for the realtor's copy of the home information sheet, which has sometimes we have remarks within that are only seen by the realtors themselves, and it could disclose a few things like that, like the words being sold as is, for instance, could possibly raise some flags. Or removal of asbestos report is available, those kind of things I'm sure will raise some flags. And that's where my job is to kind of educate the buyer as well on, okay, you are buying this, it says as is, you need to talk to your lender and see, is this going to be an issue for you to get a mortgage? What are they going to be? What are the red flags there for them? So we've seen that a lot lately. No one wants to take responsibilities anymore, right? So
that's actually a great point, because that is something we see where if they thought it was a cute idea, to put handyman's dream or something like that, that's going to raise those same red flags, like you said. Also, bank sales. As we're seeing cost of everything going up, and we're seeing people who have struggled financially, and we're seeing a couple more bank sales popping up here and there. A lender is going to ask for an inspection on those bank sales, because unfortunately the people who have lost that home obviously are not leaving that home willingly. So the lender wants to know what the condition of that property is. And again, if there's no inspection, a recent inspection, that's going to be a problem. So the verbiage found in those listing, the listing itself put in by the agents, that's crucial. It's key.
Yeah, and that's where we have to kind of head off on some of those issues in advance. And it's although we don't like this agents holding off offers for a week or two, not necessarily 2 weeks, but 5 days to 7 days, does give the buyer a time period to do some research. And that's where I highly recommend my clients say, listen, this is the verbiage that's in here. Take it to Chris and see what he says about this. And is it going to, cause any problems when it comes down? Because if you're lifting your finance clause, you're going in with that risk of not having the clause. You could be heading down like a bit of a rabbit hole there, and may not end up getting this. And we've got to mitigate risk, right?
Yeah, absolutely.
Yeah. So anything new coming down the pipes is there any sunshine in your world that we can, pass on to buyers?
What to pass on to buyers? In terms of,
I don't know. There's not too much good news around these days. Give us a little.
I think that the one thing is that, I mean, luckily in Canada, we have a lot of competition for buyers. And what I mean by that is there's a lot of lenders out there, right? So not only is it the big banks, but you also have these non-bank lenders. Some of them are owned by banks, some of them are sister companies by banks, and some of them are their own institutions. And some of them you would have never heard of because they just deal in the broker channel. They're every bit as legitimate as the banks are. They're federally regulated, et cetera. And then on top of that, you also have credit unions. You also have financial institutions like Manulife. Like a number of these are competing for that mortgage business. So as much as we're saying rates are going up, and they are, it's somewhat governed by the competition, right? Like, as we know, competition is a good thing because it keeps the rates as low as they can, as low as it possibly can, because they're all competing for that mortgage business. So if I'm to say that there's any kind of bright light, I mean, it's that. And I guess the second thing I would say is that as Canadians, we've been truly spoiled over the last decade, let's say, in terms of interest rates. If you look historically, a rate of 3.25, even a rate of 4% historically is still incredibly low. So as much as it makes our, the hair on the back of our neck go up when we talk about rates going up and 3%, 3.5%, 4%, again, if we look at the last, 30 years, for example, that's still very low. So I guess I would probably say that is the glass half full in that scenario.
Yeah. And I guess we do still have that qualifying rate of 5.25, which, that gives you, the buyer should have some sort of comfort zone that, they're still qualifying you at 5.25. So there is a bit of room there for you guys in case that interest rate does go up. But so I guess to kind of wrap it up, Chris, can you give us a little bit of perspective on what mortgage professionals, the mortgage professional does versus a bank as a lender sort of thing? What products can you offer, which is different from others?
Sure. I guess the first thing I would say is, I was talking about the competition, et cetera. So as a bank, you're going to be working with the bank product and the bank representative in front of you. So they've got one institution with one institution's product. And when you're working with a mortgage broker, mortgage agent, they've got 40 some odd lenders that they are working with. So that the likelihood, not just from a rate perspective, but also the product itself is going to be perhaps the best fit in that scenario. There's some great bankers out there. I mean, a lot of our agents are former bank representatives and road reps and all that. So one of the things I would say is that, so for myself, I've been doing this since 2005, and I'm going to do this until I retire. And whereas with the bank, when there's somebody who is really good at what they do, typically they're going to be promoted and they're going to be moved around, et cetera. So it's the consistency of the relationship. If consistency of a relationship is important to you, somebody who knows your situation and knows your history and can keep, you can keep going back to them for that consistent advice. If that's important to you, that's what a mortgage agent can offer. Because again, the turnover rate for a mortgage professional versus the banker is far less. So, and like I said, because if that banker is very good, he's going to be promoted on. The mortgage professional is going to be, staying in their career like I have since 2005. So I'd say that would be another value add from a mortgage agent's perspective. I guess I would say those two things: the product itself and explaining the product and going over what might be the best fit, and the consistency of that relationship. And then I guess the third thing I'd finally mention is, if we're looking at placing you in a bank mortgage, or if I place you with Scotia, or I place you with TD, or I place you with Manulife, or a credit union or non-bank lender, in those situations when we're dealing with those A-rate lenders, my commission is fully paid by the lender. It's paid from their pocket to my pocket. So there are no fees for my services. Just like a real estate agent working with somebody who's buying a home, their commission is coming from the place that they're buying, right? That there's no, if you're representing a buyer, your commission's coming from the selling agent. So there's no fees for your services. So you're getting the advantage of working with a professional, partnering with a professional at no cost in that scenario. And just like myself, if I'm putting you or placing you with an A-rate lender, there's no fee for my service. And my commission, much like the realtor, is based on the sale price of the home. Mine's based on the mortgage amount. So that's predetermined. There's no additional commission if I'm selling a rate at 350 when really the rate should be 324. It's not making a difference in my commission.
So Okay. Well, I think we've covered a lot today. I appreciate this, Chris. So I guess how do people get a hold of you, make appointment with you?
Yeah, sure. So best way is probably by email. So Chris, CHRIS at MTG, as in Matthew, Thomas, George, PROF, Peter, Robert, oceanfrank.com. That's probably the best way, is just via email. And then I'd be happy to set up an appointment by phone, by Zoom, whatever the case may be. And or they can call my cell phone, 613-561-5850.
And I will put that on the screen, and so that people can get that information easily for them. Okay, perfect. I appreciate your time and wish you a good day, Chris.
Thanks so much, Diane. Appreciate it. Thanks for having me on.
Take care.
Bye-bye.